everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, and one of the founding partners of the Dividend Kings marketplace service on Seeking Alpha. And I had a request from a subscriber who goes by the name of Esther on my last video where I covered on debt. Asked me if I would cover FedEx and UPS. The suggestion was both stocks' price had gone down, especially FedEx, and that would be an interesting story. And, I got looking at both companies, and from a value investor's perspective, which I, consider myself a value investor, that's my preferred philosophy. I like to buy good companies at sound valuations. I thought these would be timely and interesting to cover here in my next video series. So let me start here with FedEx, which is the smaller of the two, and go over just a couple of the metrics here. Number one, I want you to notice the stock has a earnings yield of about 7.3%, and I'll get into that in a moment. A dividend yield of just under 2%. We'll call it 2% for government work. It has about a $34 billion market cap. It does have investment grade credit, BBB, and has 59% long-term debt to capital. Now, what I've got here on the graph right now is the company's adjusted operating earnings per share. Okay, this is not GAAP. This is adjusted operating earnings. I want you to notice that their earnings have been, they've grown at about almost 8% a year, but they've been cyclical. They were down pretty sharply during the Great Recession. They went through the 2001 recession without too much trouble. They were down a little bit of weakness. But what's really interesting when I so before I do that, this is a 15 PE ratio, which is a formula that's utilized, that's kind of discounted cash flow based to give an optimum valuation level for a stock. And I'm using the 15 PE ratio, which is one that's quite common. So anywhere the stock price touches the orange line, it would be a 15 PE ratio. I think it's important for you to have that perspective. So let me put monthly closing stock prices on the graph now. And this is the black line. And what I really like about this particular graph, or I found it fascinating, was how, I've always said earnings determine market price in the long run. In other words, where earnings go, the stock price will follow. Now, that's true from a trend line long-term basis. You can see here how clearly the stock price has tracked earnings. When earnings were rising, the stock price rose strongly. When earnings were falling, the stock price tended to follow earnings down. Now, in between, we get periods of overvaluation where the price is above the orange line, and periods of undervaluation where it's below the orange line. But there's another this is what I call a valuation reference line, by the way. And there's another valuation reference line that we always add, because this is a theoretical fair value based on using what I like to call widely accepted formulas for valuing a business. But there's also market value to consider. And that's, how does the market value the stock? So the blue line here is the normal PE ratio, and it's a PE ratio of 17.7, or we'll call it, pretty close to 18. And these numbers are always ish anyway. They're not meant to be thought of as precise. But what you're seeing here is a valuation of 15 to 18 times earnings. And you can see, how the stock price has, moved within those ranges pretty consistently over time. And it's certainly directionally moved where the earnings of the company went. So, stock price tracks earnings, and the stock price has fallen dramatically for fiscal year 2020, which ended, by the way, last month. The company has a May fiscal year. We don't have the numbers yet. It's still called an estimate, because it usually takes companies about 45 days to report. But bottom line is, we are pretty, the analysts are pretty confident that we're going to have about a 35 to 40% drop in adjusted operating earnings for fiscal year 2020. And of course, the stock price is reflecting that fear. Now, the next thing I want to add here on the graphs, I want to add dividends with what we call the dividend payout ratio. This green shaded area is all the company's earnings. The white line is a plotting of the company's dividends per share. And the area below the white line is the payout ratio. What portion of these total earnings does the company pay out? Now, obviously, when the earnings are high, like they were coming into the Great Recession, the payout ratio will be real low. Here it was 5.4%. If earnings would fall, even though the company still maintained a very similar dividend from 40 to 44 cents, now all of a sudden we're seeing a payout ratio of about 12%. But the point is, by just looking at this graphically, you can see that this company doesn't pay out very much of its earnings. And there's a couple of reasons for that, and we'll get into it later. Now, the next thing I do is I take these earnings, or these dividends rather, and I put them on top of the graph, because in a light green shaded area here, because the idea is for the user of FastGraphs to understand that the price is going to generate the capital appreciation when the price moves from point A to point B, but you also get the dividend income. So let's take a quick look at performance here on FedEx and look at how it's performed since going back to May fiscal year ending in 2000, May 31st, 2000. And what you're looking at is a proverbial or hypothetical $10,000 investment would have generated $4,160 of dividend income, and that compares very favorably to the S&P. Slightly underperformed it from an income, but it's very comparable, I should say, not favorable to the S&P. But from a capital appreciation point of view, $10,000 would have grown to $36,777 versus $21,400 over this same time frame in the S&P. But I also want to point out that FedEx now is trading at a blended PE ratio of 13.7, and the market's trading at something like a 21 blended PE. So, the company is at a very, price-wise, valuation-wise, at a big disadvantage to the market. Nevertheless, they have slightly outperformed. Company's grown about 7.9%, but you can see it's been very cyclical. But again, the most interesting thing is, look how the price has tracked the earnings. Now, another type of earnings that I like to look at when I'm valuing a business is owner's earnings. It's allegedly one of Warren Buffett's favorites. Owner's earnings are slightly different because they take into consideration CapEx, and CapEx is going to be a discussion point here because it's an issue with FedEx that I'll get into as far as dividend coverage, because next I want to go into operating cash flows. Now, although operating cash flows can be a very interesting valuation metric, you can see in the case of FedEx, the company trades at about 8.2. That's the blue line on the graph times cash flow. That tends to be the normal priced operating cash flow, but they produce a lot higher cash flow than they do dividends. You can see their cash flow in fiscal year 2019 was $21 a share to cover a $2.60 dividend. So they have plenty of operating cash flow to cover their dividend, but the problem gets to be when you look at free cash flow. Now, when I'm looking at free cash flow, I've taken price and the normal valuation. This isn't really a valuation metric to me. This is really a dividend safety metric. And one of the issues are that FedEx, you can notice here, I want you to notice, has negative free cash flow in 2018, a very little bit of free cash flow in 2019, and then negative free cash flow expected for fiscal year ending, that ended May of 2020 at 525, and they're still estimating negative free cash flow next year before we start to see potentially positive free cash flow. Now, there's a reason for that, and that takes me into looking into fund graphs, which I'll get to, but I want to start with gross and net margins. You can see their gross margins have ranged in the 20% range, as high as 23, 24, etc. But their net margins can be rather slim sometimes, 4.5% in 2014, 7% in 2018, 0.77% in 2019. Then if I go into the quarters that have been recently produced for the fiscal year 2020, you can see that they actually had about 1.8 net margin for the February of 2020 quarter, which would be their third quarter. So the company does have very thin margins. Now, other metrics that I want to look at that I think are important, let's look at return on assets. You can see they were producing pretty strong returns on assets, but recently they haven't been. Their actual returns on assets have actually turned negative. When I look at returns on equity, similarly, I see negative returns on equity, and then returns on invested capital is also negative and looks poor. Now, there's a reason for that. And that reason is capital expenditures. So we're looking at capital expenditures per share here, and I want you to see that they are spending over $20 a share in capital expenditures. Now, when I compare that to the operating cash flow that I showed you on the actual fast graph, you can see that operating cash flow numbers are actually lower than their CapEx in the last couple of years. So that's but otherwise they're always spending the majority of their operating cash flow on CapEx. And as a result, when I then turn into free cash flow and look at free cash flow, we can see that their free cash flow is negative because they're spending all this money on CapEx, and they have to do that. There was a news article on the fast graph, you noticed, where they just ordered 50 new planes. The company's constantly spending money. Now, on the Dividend Kings, interestingly enough, on a safety score, we give FedEx a score of 7 out of 11, which is pretty good. That's a quality score. And then a dividend safety score, we give it a 3 out of 5. And I think the reason for that is because their free cash flow payout ratio is so darn high. If you look at their free cash flow payout ratio, it's very it's actually been negative. They're not generating enough free cash flow to even cover their dividends. So that's something that concerns me a little bit about this stock, and I wanted to bring that up. But CapEx is the culprit there. Now, before I finish with FedEx, I want to take a quick look here at Morningstar. I happen to be a subscriber, and I'm looking at the economic moat. Now, they give FedEx a narrow moat, but they do point out that the reason that they do give them a moat at all is because it'd be very difficult. There's lots of what they called formidable barriers to entry to come into this business. And they talked about how DHL, which is a third major carrier that operates worldwide but primarily in Europe, actually left the U.S. simply because they were tired of losing money trying to compete with FedEx and UPS. But anyway, that's my presentation on FedEx. The next, let's move right into UPS, United Parcel Services here, and compare it. Now, I'm not going to go through the explanation of the fast graph like I did with FedEx, so hopefully we can move a little quicker here, but I do want you to see some interesting things here. Number one is that the market has given this company historically a premium valuation. They've been willing to average this stock. The normal PE has been over 21, and again, there's that normal 15 PE ratio, which you can see this stock has very seldom traded at that valuation. But at the same time, we once again see a pretty good picture here where earnings determine market price, and where earnings go, stock price goes. So again, we see clear periods of overvaluation, not quite as much undervaluation, and we're not seeing quite as much drop in earnings like we did with FedEx in the previous example, but we are seeing a drop in earnings here as well. And we are able to buy this now at a sub 15 PE. Blended PE of 14.79. It does have an earnings yield of 6.76%, and for if you're looking for dividend income, a dividend yield of 4.05%. Now, keep in mind, I want you to look at the high valuation here and I'll call it fair valuation now, but let's look at performance, keeping those valuation metrics in mind. The company has not performed as well as FedEx. I think a lot of that's attributed to the high valuation on a capital gain basis. They generated, and this has a different fiscal year here now. Okay, so we're looking at a December fiscal year, not May, so we've got slightly different time frames. But you can see that over the comparable period of time here, it's underperformed the market on capital appreciation, but not too badly. But it's produced significantly more dividend income than the market. It came out with a comparable rate of return of the market. And again, that's with the stock facing the headwinds of overvaluation in the beginning and then now fair valuation at the end, where we have a market that's generally overvalued, but it's comparable. But now the dividend record is important. They've been a very consistent producer of dividend income. Occasionally they have froze the dividend like they did in 2009 coming out of the recession. They also froze it during the 2001 recession as we came out of the 2001 recession. But interestingly enough, they didn't cut it, and so they've been a very consistent dividend producer. Notice their dividend payout ratio is much higher. If I put it into the numbers here, you can see it's in the 40 and 50% range, and it has increased in recent years. And of course, these high payout ratios are functionally related to dips in earnings. That's when the dividend payout ratio got high. The growth rate's about 5.7%. Again, it's A-rated with 76% long-term debt to capital, but it has a market cap of just under 86 billion, or over 108 billion if you look at total enterprise value. So a much bigger company than we saw with FedEx. Now, let's move on to some of the other metrics very quickly that we scrutinized FedEx with. So here we're looking again at Warren Buffett's favorite, owner's earnings, which includes estimates and has CapEx consideration. And once again, we see a stock here with pretty erratic earnings when you're looking at owner's earnings on UPS, but it's theoretically trading at a fair valuation relative to expectations going forward. The next here, let's look at operating cash flow. Very similar to owner's earnings in a lot of ways, but the point is, UPS does not have the operating cash flow history, the strong operating cash flow history that we saw with FedEx. There are times when the payout ratio got over 100% on their operating cash flow, which FedEx had very low operating cash flow payout ratios, if you recall. Then finally, let's look at the company from a standpoint of free cash flow. Once again, we see a kind of a spotty free cash flow record. There have been several times when UPS did not cover their dividend with free cash flow. I took price again off the graph and the normal valuation level of cash flow, because I don't really value stocks so much on cash flow. I'm looking at dividend safety and dividend coverage. Now, interestingly enough, on the Dividend Kings, if you go through all the metrics we use there, this scores out as a quality score of 9 out of 11 compared to a very similar one with FedEx. And then the dividend safety is a little higher at 4. And of course, that's partially because it has an A credit rating, but it does have higher debt to capital. So let's go ahead now and move in to the fund graphs, the financial underlying numbers like we did with FedEx. Let's start with gross and net margins like we did FedEx. A little better story here. Their gross margins are about the same in the 20% range. Their net margins are a little more consistent, a little better. So they've held up quite a bit better from a standpoint of gross and net profit margins than we saw with FedEx. That's something to take into consideration. UPS's return on assets is a little better. Their return on equity is also a little stronger than what we saw with FedEx. And then their return on invested capital is also a little stronger than we saw with FedEx. So I've got a little bit better numbers here. So next, let's go back to this dividend safety thing a little bit, and let's look at capital expenditures per share. And here we see, again, a very high growth in capital expenditures in recent years here. And then when I compare that to operating cash flows like I did with FedEx, the company does, in this case, generate much more operating cash flow when they're generating it than they do CapEx, but their record isn't quite as good as what we saw with FedEx. And then, of course, when I'm looking at free cash flow, which to me is the real operating test here, when I look at free cash flow relative to CapEx, you can see why the company has had negative free cash flow so many times, because they would obviously at times be spending a great deal of money on CapEx, completely eliminating their free cash flow. Now I'll kind of close here by going to Morningstar and look at UPS from a standpoint of Morningstar. And the difference here is Morningstar gives them a wide moat and compared to a narrow moat that they utilized with FedEx. So from that point of view, that might also partially explain why we give it a higher safety ranking as well. Because, bottom line is this company is one of the dominant carriers of all, and they've really been very well established, and they're also very, very large. So anyway, there you have it, FedEx compared to UPS, two kind of, obviously very similar businesses in a very similar industry, but quite a bit of difference in terms of operating results and some of the other important metrics that help determine safety and dividend. Of course, FedEx, a little growthier with a lower dividend yield. UPS, in contrast, is a little slower growing, but a much bigger company with a much higher dividend yield. So technically speaking, from my perspective, they're really two different companies for two different kind of results. With UPS, we got a much higher 4% dividend yield, a very good long-term record of raising the dividend. We've got decent valuation in both companies. UPS would theoretically be slightly a higher quality company, mainly I think because it's a much bigger, much more established company. But both these stocks could fit the right portfolio depending on the investment objectives. And what I also hope you got out of this was you saw that, FastGraphs is a very interesting fundamentals analyzer software tool. It allows you to take a really hard look at the insides of companies, their fundamentals, a lot of different fundamental metrics. If you like it, I might suggest you go ahead and try a 14-day free trial. We got somewhere between 15 to 20,000 U.S. and Canadian stocks that you can run through this kind of rigorous process with. Anyway, this has been Chuck Carnevale saying thanks for watching. Of course, if you also like these videos, don't forget to subscribe to my YouTube channel here. Thanks for watching.